Hello everyone. Today we will discuss chapter 3, learning objective 5. This is basically an example from your textbook, example 3-3. Here is the example. You can read it through as I will do next. And we are given some key financial figures about this corporation in terms of sales, cost of goods sold, and some other expenses and income. Now we are asked to compute the tax liability of this firm. Underneath the wording of the question, you will see an income statement. So I would like to indicate to all of you, you've taken fundamentals of financial accounting previously, I assume. So this is an income statement. Let's see if things are in order in this income statement. We start our income statement as usual with sales. That's perfect. And the text tells us that sales during the past year were $5 million. And next to it, we know the cost of goods sold were a mere $3 million. And that's also taken care of in the second line. And the difference between those two figures will give us one of our first results, which is important, as you can imagine. It is the difference, as I said, would be the gross profit for this firm. And in this case, $5 million minus $3 million will give you a figure of $2 million. Next, we need to deduct operating expenses, and it's clear from our text, from the text of the question, that operating expenses during the previous year were $950,000. It's clearly written on this line, and $950,000, as you can clearly see the number there. And the difference now between gross profit and operating expenses will give us our second important income indicator, which is operating income. That's crucial for our business. This has another name, alternative name. In various locations you can see it as earnings before interest and taxes. That's another way to call it. Or you can see operating profit. They are all synonymous. And in this example, the difference between $2 million and $950,000 will give you $1,050,000. Now we need to take into consideration other expenses and income for the firm, and we are told quite a few things. So we want to make sure we understand what the question tries to communicate with us as usual. I want to be clear here that we have two other sources of income expense. The first one is, it's clearly stated here that our firm received $185,000 in interest income. It is an income. We need to take that into consideration and add it into our income statement, obviously. So that's this line there. And next, we also had some expenses. As you can see, how do I know it's an expense? Because here it says paid. Paid means it's an expense, an interest expense actually, and in the amount of $40,000. So that's also reflected in the following line. Now I want to mention a few things here. First of all, you can see the numbers are aligned here, right? So that's crucial. So let me show it in a different color. So all these right alignment, that's crucial. But now you might wonder, why have we aligned these two numbers, interest income and interest expense, kind of like indented inside? The reason is we are doing a sub calculation, as you would see on this left hand side here. Interest income and interest expense is part of our other taxable income and expenses, so we are separately treating those two accounts. Income is positive, expense is negative. $185 minus $40,000 will give you for $145,000. That line, and that will be underneath the main indentation, so the main alignment. So we did a sub calculation inside, and then we go back to our statement. Now the net income is $145,000. That needs to be added to our previous earnings before interest and taxes. Therefore we come up to our ultimately to our taxable income figure, right? So this is the figure that's kind of important, and this turns out to be $1,195,000. Now like operating income, taxable income has another name as well. So sometimes we call it earnings before taxes, and so it means the same thing basically. Now that we have our taxable income, it's now step 2. In the second step, we need to figure out our tax liability, and that's what I do next. On the top portion here, now we have our corporate tax rates. This is the law. So these numbers will not change. The table 3-6, and it will be given, provided to you during different exams or quizzes and homework, and it's also available in your textbook. Now, we recall that our income, so far taxable income, was $1,195,000, this figure here, and we need to be cautious now. So this figure falls into the third tax bracket. As you can see here, $1,195,000 is in the third tax bracket, which is the 34th percentile. But that's really the marginal tax rate. Because we have a progressive tax system here, what this table tells you is that the first $50,000 of your income should be taxed at 15%. And that's what I do underneath. So the first $50,000 of our income is taxed at 15%. And for that reason, I multiply these two numbers and I come to that $7,500 figure. Now the next $25,000, and our income between $50,000 and $75,000 should be taxed at 25%. And I multiply, and it's reflected in this line here, at 25%. At 25%, we will be taxed for our next $25,000 of our income, and as a result, the tax liability of that portion of our income is $6,250. And finally, any residual. So the difference between our taxable income, which was $1,195,000, and the $50,000 and the $25,000. So the difference will be this figure here. So this is the residual number. So that number, the $1,120,000, is the number that will add up and make these things add up to our income number, which is $1,195,000. So 34% multiplied by this number, residual number, will give you this next tax liability. So you add up these three. This is your main tax liability, as you might imagine. But then we have to pay also a 5% surtax. And the reason for that is because our income surpasses this additional tax bracket. So that's important for us. So as a result, that tax, that 5% will apply, but not the 3%, because our income is not more than $15 million. So I hope it's clear here. So because we have to pay this 5% additional surtax for our income between $100,000 and $335,000, this will add up to an additional $11,750. When combining this with our previous subtotal of $394,000, we come across this final result of $406,300. So this would be our tax liability.